you can get a number that's beneficial from a tax perspective, but also documented. That's the
Okay.
goal. Because I mean,
Okay.
if we could, of course, just make up a number that is beneficial from a tax perspective, and we can stick our finger in the air and say, this seems reasonable. But that's not an argument to the IRS.
In the absence of documentation, you have absolutely nothing, no power whatsoever to be able to negotiate with the IRS.
If you have two companies commonly controlled and you have transactions between them, let's find a reasonable way to find the
Yeah.
correct price.
One point I would like to raise, and I cannot stress it enough, have a discussion. I know many small and medium sized companies, they don't want to spend money, especially on compliances. Do not consider transfer pricing as a compliance.
Welcome to another episode of Talking Expat Taxes. I'm Alex McGowin with McGowin Tax LLC, where we help individuals and small businesses with international transactions save on their taxes, but also stay compliant with the IRS. And one of the big things that I've been running into lately is, individuals with companies in different jurisdictions. And we're going to jump more into this, but where they have intercompany transactions, or maybe there's a company, trying to do business into the US and setting up their own company, and there's going to be intercompany transactions actions. Pricing those transactions is a big part of what has a big play in what we do from a tax perspective and just from a business perspective overall. And today I'm really excited to have on somebody that specializes in that type of pricing. Jinkan's here with me. We've been working together for a long time. We worked together at Grant Thornton back when I was doing international tax there, and he was doing transfer pricing. But glad to have you on, Jinkan. We're going to talk about transfer pricing in general and how it applies to a lot of people and why it's important. But yeah, glad to have you on.
Thank you so much, Alex. I'm glad to be on here. My name is Jinkan Kataria. I've been doing transfer pricing for a little over 15 years. As Alex mentioned, Alex and we connected at Grant Thornton. For the past 2 years, I have my own firm where I specialize in providing transfer pricing consulting services as well as training services, which is really applicable to companies that want some transfer pricing training in order to be able to either do it in-house, or it's also applicable to professionals who want to learn more about transfer pricing and add that additional service under the same roof for their clients.
I guess I've seen that with you working on both sides. Yeah, helping train people so they can do that type of work, and also consulting with them on the side, which is how you and I generally work together.
Exactly. I mean, the one unique feature about transfer pricing compared to the rest of the fields in taxation is that transfer pricing is purely based on economics. There are no nitty-gritty rules that you typically see in the general tax world. Um, Such rules do not really apply in transfer pricing. Yes, absolutely. There are separate rules and regulations for transfer pricing purposes, but when you look at those regulations, they are heavily economics oriented. So it's going to be a fun topic to discuss.
Yeah, for sure. And I think just starting from the top, because it's kind of a buzzword, at least if you're in the
Yeah.
industry of economics and business, it's a buzzword. But let's start with the top. What is transfer pricing? What does that mean when somebody says that word to you?
Sure. Transfer pricing, in a nutshell, means pricing of intercompany transactions. Um, what does that mean? Like you had mentioned previously, you've been getting a lot of inquiries from your clients regarding um, the clients that have set up in multiple tax jurisdictions. Let's say, for example, you have US and China, a US parent company with a related party Chinese manufacturer.
Mhm.
Obviously, whatever China is manufacturing is going to be sold to the US. Now, what is the price at which the Chinese entity is going to sell the products to the US is referred to as transfer pricing. So,
Yeah,
what I do is I help clients identify that optimal price, that optimal transfer price at which the Chinese manufacturer would sell the product to the US.
right.
And that's what transfer pricing essentially means. Now, I would also like to add that transfer pricing is not necessarily only applied to cross-border transactions, but it
Uh,
is also applicable to intrastate within the US domestic transactions as well. Because
right.
we
Just any
have
jurisdiction that has different tax system, right?
exactly. Because the different states have different tax rates, there is always this arbitrage to benefit from. Certain
Right.
states do not have state income taxes whatsoever. So
Mhm.
it is also important to note that transfer pricing, while the intent of transfer pricing was to account for cross-border transactions, but over a period of time, it has also been applied to the domestic transactions as well,
Yeah.
especially when you are set up in different states. And if the tax rates between both the states are the same, then it's not as much of an issue. Because, or rather, I must say, if the states where you're transacting in are unitary states, where you're filing a combined tax return for those states, then it's
Yeah.
not much of an issue. However, if it is not combined states, it is just unitary states, and especially the states that do not have any state income taxes, then transfer pricing is a big deal for the state
Yeah. Yeah. It
purposes.
makes sense. That's a good point. I mean, of course, I focus on international work, and so I'm usually seeing it from the international side. And also, when I see a lot of states going on at a company, I usually hide under my desk or run and hide because state taxes scare me because they're so complicated. So I have other people that help me with that stuff. But interesting point. I talked to a guy yesterday. He's in Florida. I can't remember, he's British or something, but he was looking to leave the US and he was looking for, a tax friendly way to leave. And the best option on the table for a US citizen is Puerto Rico. And not to get in the weeds of Puerto Rico has the Act 60. And one of the benefits of Act 60 is that if you're self employed, you have your own business, you can set up a business in Puerto Rico and your existing business in the US, pay a commission to your business in Puerto Rico, and you get a 4% rate. But the thing that his advisors in Puerto Rico didn't mention, and I'm going to get you plugged into this guy as well, is you can't just pick a number and
Correct.
send it over to the jurisdiction in Puerto Rico because both Puerto Rico and the US, although complicated with the territory thing going on, but they're two different tax jurisdictions and they
Correct.
care. You can't just make up the price. So there has to be economically, and what's the words, arm's length, right? That's
Correct. So transfer pricing, I was going to get to the arm's length standard shortly, but thank you for bringing that up, Alex. Pricing of transaction is one thing, and what strategy you're using, what fundamental you are using to price that transaction is another, right? For most people, performing transactions between related parties is nothing different from moving money from right pocket to left pocket, right? It's all staying under one consolidated entity. However, if you think about it a bit differently, a tax recipient standpoint, which is two different tax jurisdictions, so two different tax collectors, who has the right to tax what plays an even more important role. So, in case of Puerto Rico and the US, I don't know off the top of my head what the tax rates are in Puerto Rico, but it sounds like, based on what you just mentioned, sounds like the tax rates in Puerto Rico are much, much, much lower than what it is in the US.
right.
So, yeah. So now the IRS wants to tax you on the fair income that should belong to the US. Puerto Rico wants to tax you on the fair income that belongs to Puerto Rico. So in your situation, you cannot just blindly say, oh, why don't I pay 50% commission and move all of my profits to Puerto Rico?
Yeah, of course.
While
No
Puerto
brainer.
Rico, yeah, while Puerto Rico authorities are going to be happy about it, they're going to get more income to tax, but the IRS isn't going to be happy about it, right? So IRS is going to want to know, but what policy are you using for this intercompany transaction and the intercompany payment that you're making? And whether it is arm's length or not. So, arm's length is the one defining fundamental, not just the US, but globally, that all the tax jurisdictions globally follow. If you have any intercompany transactions, they need to be priced on an arm's length basis. What does that mean? Arm's length basis simply means how much would you charge for a similar transaction to a third party. So arm's length essentially means what is the market driven price associated with a particular transaction in question here.
All right. Yeah. Yeah, makes sense. I mean, yeah, and I think the point I wanted to stress is it comes up more often than people think. Like of course when we were at Grant Thornton and you're working with these big companies that have 30 subsidiaries all over the world with intellectual property and royalties, of course, that's an obvious. But people don't realize how much it comes up with small businesses as well, whether it's interstate. I mean, I work with, for example, I was one of the things I advise on for people, maybe a higher net worth person that's looking to move outside the US. One deferral of income strategy that I use with people is, let's say they have an S corp or partnership in the US,
Mm-hmm.
and then they move to a foreign country and they can siphon, that's probably the wrong word to use, but they can
I'll take it back.
right.
Take it back.
You set up a foreign company to, I guess, do some work for the U.S. company and you own both. So now you have two companies you own in two different tax jurisdictions, and a payment going to the foreign company. And in a way, we can find a way to potentially defer income to the foreign company. But I mean, it's all a fun game to talk about, like move money from here out of the
Yeah,
U.S.
yeah.
into the foreign country, into the foreign company. And you can make it make sense from a tax perspective. But again, we have to go back to the economics of it. And I guess this is where I kind of wanted to jump into some of the benefits versus risks of transfer pricing, in that, let's say, like my scenario, you just picked a number for Puerto Rico or whichever scenario you want. You just pick a number that benefits to send it outside the US. There's obviously a risk there, but there's
Which is
also a
what most
benefit.
taxpayers want to do, right? They just pick a number. What are the risks associated with it? They don't even think about it. And that's where it kind of becomes a crucial matter to think about more.
Right. So can you kind of hone in a little bit on the practical side of doing transfer pricing? So if somebody calls you and they're like, "Hey, I have this intercompany transaction," of course, the point of it is to have the most beneficial price from a tax perspective possible. So how do we document that and stay out of trouble, and what are our options?
So many different things going on here. I'll tell you through my experiences when I'm talking to a CFO of a company. The CFO is like, why do I even care about transfer pricing? It's right pocket versus left pocket, right? And that's
Right.
when you have to explain to the CFO or anyone who's asking this question that it's not really about the company, but it's about the taxation authority when all of your companies are operating in, and what is the fair share of taxes that they want to be collecting from the income associated with that particular country, right?
Right.
In your example, you have Puerto Rico and the US. Now, obviously, in the US, we have a global taxation system, but you're not being taxed until the money is remitted back into the US, right? So, in your
Right.
situation of Puerto Rico and the US,
Let's throw real quick. Let's throw a more common scenario out there, because I just threw two like really like out there type of scenario. A more common scenario that I see is U.S. company that sets up an Indian private limited company, and they
yeah,
have it's a support center.
yeah, a
India's
back
got
office.
one.
Yeah.
India's going to want to make sure there's a profit there, but it only exists for the U.S. company as a scenario, and there's transactions going back and forth. That's a very common scenario.
That's one of the most common scenarios you'll come across, not just India. I would say pretty much all
Yeah.
the relatively cheaper labor countries where you want to set up your back office support functions and whatnot, obviously for, availing the cheaper labor and increasing your bottom line. So in those situations, you have to ensure that whatever transactions are being conducted, let's say India, right? In your example that you just gave, once upon a time, India had a tax holiday on foreign companies setting up operations in India. And because of those tax holidays, the US company would think, why do I not, through transfer pricing, why do I not send all of my profits to India? That way, I'm not being taxed in the US, because on the US's books, you're going to be showing a zero taxable income. And on India's books, you'll be showing all of the profits, right? And
So in
because
other words, when you say show the profits, so you're going to have expenses in India, and so you're going to compensate the Indian subsidiary
with the
more than you
expenses
probably would from an Franks' base. So if you have
correct,
$100,000 of expenses in India, maybe you pay them $200,000 for those
correct.
and book the profit over there. That's what we're talking about.
Correct. So now that obviously this is a very made up scenario. So in this situation, that's what the companies would want to do. And the CFO would be like, hey, why do I care? It's a right pocket, left pocket. I can, this is just benefiting me from tax standpoint. And the answer to that question, the biggest red flag is your pricing of that intercompany transaction. Is it arm's length? Is that the amount of money you being in the US pay to a third party? If a similar third party, let's say a similar company, which is a third party in India, you were to avail outsourcing services from them, would you have paid $200,000 to them? The answer to that question most likely is going to be no, right? It's
Right.
going to be some amount, whatever that amount is, but it's not going to be moving all of your profit through transfer pricing from the US to India, right?
Right.
So that's where, I have to educate the stakeholders of the company that it's not what you want to do. It's about what the tax authorities, it's about what the tax authorities can charge you on, right? Can tax you on. And that tax needs to be on the basis of a fair income that you need to earn through transfer pricing purposes.
Right.
So that's number one, which is obviously, it creates a lot of risk. Now, assume for a minute the tax holiday situation that I just explained. Forget about tax holiday. Let's say in India, you have a tax rate of 30%. US, you have a tax rate of 30%. Okay. Now, in that situation, the CFO comes in and says, why do I care about transfer pricing? I'm not trying to cheat here. I'm not trying to avail a lower tax rate in any country by moving profit from one country to another, right? So why do I even care about transfer pricing in that situation, especially if there is no tax arbitrage to avail from whatsoever?
Right.
In those situations, what happens is, let's say you moved all of your profit to India, right? You're paying 30% tax in India. The
Mhm.
IRS comes in and says, wait a minute, you have not applied transfer pricing on an arm's length manner. You should have paid India half of what you paid, right? So I am going to make an assessment on your US tax return as if you earned that income in the US, and therefore I'm going to assess you additional taxes on that, right? So
Right.
on one hand, you've already paid 30% tax in India on 100% of the income that you shifted to India.
Right.
And we don't want to say that, you messed up your transfer pricing or whatever. For whatever reason, you didn't care, you didn't look into it, you didn't care about it. Just so happened that 100% of your profit moved to India. You paid taxes in India. In the US, you showed zero taxable income. IRS came in, audited you, and said, I'm going to assess taxes on you because your transfer pricing was not arm's length.
Mhm.
The IRS is going to assess taxes on the income that it thinks, it feels is arm's length for US purposes.
Right. But
So
you still pay
now,
tax in India. Right.
exactly, you've already paid the taxes in India, and now you're going to pay extra taxes in the UN based on whatever assessment the IRS is doing through audit,
Now you got to go convince India that the IRS was right.
which is going to be next to impossible because it's a very, very, very lengthy process. You will have to involve experts, consultants. You have to
Mhm.
pay significant amount of money to all of those people, and there is no guarantee that you're going to get the refund, right? The Indian Taxation Authority is going to be like, hey, you know what? You've paid me already. There's nothing we can do about it. In the future, you correct your transfer pricing according, right? Now,
Right.
there are treaties between many countries to avoid double taxation. um, but regardless of the treaties, you still have to follow the process, and
Right.
nobody knows whether the process is going to work or not, right?
Right.
Not only is it a lengthy process, it's a very costly process to undertake as well. And companies are in the business of doing business. They're not in the business of figuring out the taxation stuff, getting the refund here, getting the refund there. It's
Right.
it's their consultants, their tax experts who take care of all those things, right? So it becomes very important to consider those points as well. So
So
not,
how
it's a,
would you document? So how would you, for example, what are your options I guess, in your scenario of the IRS coming to you and challenging your pricing, what do you need to have on your side to figure that out? Like, how do you come up with the price?
Yeah. I mean,
I
how
mean,
do companies?
that's a loaded question. I realize
Yeah.
that. Well, generally, it's a comparable analysis based on some methodology, right?
Comparable analysis, yes. I mean, so you've said it correctly. There are many different components involved here. The first and foremost is conducting what we refer to as, what we transfer pricing experts refer to as functional analysis. Functional analysis is a complete, uh, it's a complete um, understanding of the company's business, right? What business are you in? What kind of functions you're performing? Where are those functions being performed? So on and so forth. So in this example, India and the US, you figure out, okay, what is the business that you're in? What are the employees working in the US? How they are structured? What are the employees working in India? How they are structured? What is it that India is doing? So in this particular situation, you identify that India is simply providing you with back office support services. Let's say call center services, right? They are inbound, outbound. They're just making calls to random customers. They are answering calls that are coming inbound, so on and so forth. So in that situation, after conducting a thorough functional analysis, you have a better understanding of the company. And now you are determining what is the intercompany transaction that is being undertaken. The intercompany transaction is India providing back office support service. Once you've identified the intercompany transaction, the next step is to identify the transfer pricing methodology that you want to use to derive the arm's length transfer price for this particular transaction.
Okay.
There are quite a few transfer pricing methods that are available to choose from. Each
Right.
method has its own merits and demerits, and in
Right.
certain
That's where
situations,
somebody like you comes in and says, "This is what we need to do and how we need to do it." But
correct. This
you
is
have
where
to
I would
follow you have to follow one of the prescribed methods and document your findings and find.
document your findings, and based on the method that you've chosen, there may be a requirement of performing comparable analysis. That's where you're identifying third party comparable companies that are performing functions similar to what your India back office service provider is performing, and then identifying what is the profitability that these third party similar companies, comparable companies, are earning. And you would, typically target a range, a point within the range that you arrive at. And then the typical range that we rely on is referred to as interquartile range. And there are specialized databases available in the market that you rely on in order to do this level of research.
And the benefit of that is that you can get a number that's beneficial from a tax perspective, but also documented. That's the goal. Because I mean, we could, of course, just make up a number that is beneficial from a tax perspective, and we can stick our finger in the air and say, this seems reasonable. But that's not an argument to the IRS.
Not at
When
all.
we come-
Without
when they-
documentation, none of it.
They're gonna if the IRS sniffs out that you have no documentation on it, they're gonna go to the extreme because they can.
Correct. Exactly.
Whereas if you hand them documentation for transfer pricing purposes, I haven't been in a lot of these audits, but I've been in a few, and I mean, they're depending on the size of the company, they're pretty quick to fold on a very nice looking, documentation on transfer pricing.
100% agree. So documentation becomes extremely critical in supporting the transfer pricing arrangement that you are doing.
Yeah.
In the absence of documentation, you have absolutely nothing, no power whatsoever to be able to negotiate with the IRS. Now, it is quite possible that despite having the documentation, let's say whoever did the transfer pricing, whatever they were thinking, that transfer pricing was done completely incorrectly, right? But there is documentation in play. The fact that there is documentation in play, the fact that the taxpayer made a good faith effort to look into their transfer pricing arrangement itself gives you some negotiation power, right? Without documentation, you do not get anything whatsoever.
Right.
So documentation becomes extremely critical.
Another big thing I wanted to talk to you about too is that there's levels to documentation, right? I mean, with bigger companies, there is, and I'm going to butcher the code section, but what do they call the documentation that actually gets you out of penalties, even if you're wrong?
6662. Yeah, that's under section.
Okay, all right, yeah. Yeah, so the 6662 documentation, that's like your big study that's going to have your functional analysis and all the records. It's a
Correct.
50 to 100 page document sometimes,
Yeah, I mean, so there are two components here. Now, obviously, you have to consider what is the size of the company you're talking about,
Right.
and whether you have to do the cost benefit analysis also, right? So, the two components in transfer pricing is one, you're establishing transfer pricing, which is called your planning documentation. And the
Mhm.
second is your compliance documentation, where you are justifying the transfer pricing arrangement that you're using. Now, compliance documentation is purely, at least in the US, purely for the purposes of penalty protection. What does that mean? You did your planning study, you have a planning documentation, all right? The planning documentation, let's say in this particular example, India providing back office support services to the US, you're charging a cost plus markup of 10%. You have a planning documentation in place. The IRS comes in, you have a planning documentation and you're applying that transfer pricing arrangement, right? 3 years down the line, the IRS comes in and says, okay, show me your transfer pricing study, right? They see the transfer pricing study and they say, oh, by the way, it should not have been 10%. It should have been 5%, which means you paid 5% extra markup to India. So then at that point of time, the IRS will say, let me make an adjustment of 5% income in the US. And then they will tax you on that 5% income in the US, right? Not only will you have to pay additional taxes, but you will also have to pay penalties and interest if you do not have that compliance documentation, which is governed under 6662 section.
Right.
So compliance documentation will help you to protect from penalties. Now, for a smaller company, does it make sense to spend $5,000, $10,000 on compliance documentation every single year, especially if your transactions are worth only $50,000? The answer to that question is probably not, right? Absolutely not. So that's when you have to ensure that the planning documentation that you have in play is so robust in nature that it will help you justify the pricing for next 3, 4, 5 years.
Right. Yeah. So, I mean, that's what I was going to say is there's different levels to transfer pricing. And I think at a smaller level, a more practical approach is, yes, getting a defensible number that you can hand something to an auditor, that lasts multiple years. And it's not just a finger in the air approach that gives you no leverage with the IRS whatsoever.
Correct.
And I'll add one more thing that I just thought about, because you and I worked together on a recent client that, in my experience, most people that have transfer pricing without really knowing what that means, they're making transactions between two commonly owned companies. And they do a cost plus analysis. That's what everybody, like if they say, all right, here's the cost that's going on over here. We'll just add 2% of it. We're good. That is rarely the actually correct way to do it. And not more important than that, it's not the most beneficial way to do it. Because you and I worked together on one recently where, we had an African company and they were doing this cost plus on a number that wasn't really the basis of the intercompany transaction in the first place. And
Correct.
you redid it completely to where we were using a totally different methodology than cost plus. And it gave them a much bigger benefit that they can now also defend. The cost plus defense is not a defense at the end of the day.
I mean, it's not a big
comparable.
Exactly.
But I wanted to point that out, that finding a different methodology gives you a better benefit, not only a defensible one, but a better answer.
A better answer. End of the day, you got to look into two aspects. One is tax optimization. If through transfer pricing, you're able to optimize your taxes, and by optimization, I mean obviously minimization of taxes to get your better effective tax rates. And the second thing is risk mitigation. In the prior example, we saw the double taxation, right? In order to mitigate the risk of potentially being hit by double taxation, you have to ensure that not only your transparency is done accurately, but you have all the appropriate documentation and justification for that. And then whether or not you want to do the compliance documentation is something that you can figure out over a period of time, right?
Right.
And you brought up a very good example, Alex, where you and I, we worked for this client. We went in, they had a cost plus in place. Not only was it an incorrect methodology to use to begin with, but even with the incorrect methodology, they had used the wrong cost base, they had used the wrong markups and whatnot, right?
Right.
You and
Right.
I went in, we did the whole functional analysis, as you recall. We discussed every single thing about the company, who's performing what are the functions being performed in which country and whatnot. And then we arrived at a methodology that was entirely different from the cost plus methodology.
Right.
And the answer that we came up with was not only justifiable, but it gave them a huge tax benefit. Obviously, you're mitigating risk automatically by having the justification and documentation, right? So that would be a classic example. And in this company we are talking about had revenues of about $2 million, right? So not significant amount of profits for this company, but I mean, hey, whatever profits that you have, you got to ensure that you're paying only the taxes that you should be paying. You shouldn't be paying more taxes. No, you
And you
should
don't
be
have to
paying.
worry about, and you don't have to worry year on year that you're going to get audited and have no defense for the intercompany transactions you have.
Exactly.
You
And
can
when you
sleep at
do
night and save money at the same time. That's kind of
exactly, I mean, you don't want
yeah.
to be in a situation where the auditor comes in, hey, how did you choose this? I don't know. I stuck my finger in the air and I felt like using this thing,
Exactly.
or my consultant told me to use this. Okay, if your consultant told you to use this particular
I would
methodology,
come up with it.
where
Yeah.
is the proof for that? Show me the documentation. And if you
So the
do not
point,
have it at that point of time, you're already fighting a lost battle, right? You're just going to be hit with whatever taxes, penalties, interest that the tax authority wants to do. And the penalties could really creep up. In the US, it's 20% or 40% of the assessed taxes. But globally, it can potentially go as high as 400% of additional taxes assessed. So you
right.
got to play your cards really, really, really right.
Right, for sure. And I think that the thing I wanted to stress with the documentation part of this was you don't have to be a multi-million-dollar company for transfer pricing to make
Yeah,
sense
not at
or
all.
be
Exactly.
practical for you. And I think that's a misconception that a lot of small businesses have, small, medium-sized businesses, whatever that definition is. But yeah, they think, oh, the IRS isn't, first of all, it's usually the IRS isn't looking at me, I'm a small fish. Not necessarily true. I've seen that to be
Yeah,
not true at
exactly.
all. It's actually, in a lot of cases, easier and cheaper for the IRS to go after a small fish from a
Because they
transfer
don't
price
have anything.
because they're not going to have anything. It's going to be, yeah, they're going to assess, they're going to have no leverage. Whereas they know if they go to Coca
Yeah,
Cola, they're going to have a decades long battle in their hands with transfer price.
exactly. I
So,
mean,
yeah, very, yeah,
the point I would also add to what you said is you're not getting small and medium business, right? You're not getting audited every single year. Audit needs to happen once,
right,
right? For the IRS or any taxation authority to come in and challenge your transpricing arrangement. If you don't have anything, then you're screwed to begin with. But if you have something, then it gives you some justification, some leverage to negotiate on. But once you get audited, let's say 10 years down the line, you're getting audited, and the IRS, for whatever reason, finds out that all they have to do is say, there is a fraud here. You moved all of your income to a low taxing jurisdiction or whatever the case may be, right? In that situation, the statute of limitation go out window. They are
right.
applying the transfer pricing adjustment to the beginning of time, which means
But based on the fraudulent nature of it.
exactly. All they have to do, I mean, that could be a chance, right? Where, a small company, they're never going to catch me. Let me just move all of my, in your example of Puerto Rico and the US, let me just charge a 50% commission. That way, all of my US profits are going sitting in Puerto Rico. And
Right.
that's when you will realize, like, maybe 8, 9 years, you're not getting caught. But that 1 year, 10th year, if you're getting caught, would be a fraudulent case, and then all of the back years will be open. There won't be any statute of limitation, which in the US we have 3 years, by the way. But in case of fraudulent cases,
Yeah,
there's not going to be any statute of limitation, which means for each of the 10 years, not only will there be additional taxes assessed, but there will be significant amount of penalties and interest for all the tax payments that you should have made, but you never made. And that amount could essentially be equivalent of the entire value of your bill. So
Right.
you don't have business essentially the next day.
Right.
You're bankrupt.
Right. So, yeah, I think it just goes to show, don't stick your finger in there. If you have two companies commonly controlled and you have transactions between them, let's find a reasonable way to find the correct price.
And discuss with your advisors,
Yeah.
discuss with your advisors. You do not necessarily have to perform a study in every single case, but having some kind of hand holding from your advisors, some kind of support justification from your advisors to be able to be in a better negotiation phase with the taxation authority. And very similar to what we did with the client that you and I are talking about, Alex, right?
Yeah, exactly.
Yeah, they didn't want to pay tens of thousands of dollars to prepare a detailed transfer pricing study. We came up with a very simpler approach. But even with the simpler approach, we were able to justify the transfer pricing arrangement as well as give them a better tax answer.
Oh, exactly. And that's the balance that we're going after from a tax
Correct.
perspective. Well, very good, Jinkan. I really appreciate it. So how can people reach out to you if they have transfer pricing questions or need your help?
They can reach out to you directly, Alex. They can reach out to me. They can email me at jinkan.kataria@capmconsulting.com, which is a pretty long email. You can just visit my website, Capem Consulting. You'll see, you can just reach out to me from there. But the best way to reach out would be through Alex as well. Alex and I, we work very closely. But before we close out, one point I would like to raise, and I cannot stress it enough. At least have a discussion. I know many small and medium-sized companies, they don't want to spend money, especially on compliances. Do not consider transfer pricing as a compliance. It is an extremely efficient planning tool available to the small and medium-sized businesses, all types of businesses really, where you can really optimize your tax position and minimize risks drastically. At least have a discussion. Do not worry about preparing a study right away. At least have a discussion to see what kind of risks are associated for not doing it and what kind of benefits you will get to do it.
Right. And are you even pricing, the flows of your intercompany transactions, do they even make sense? Having an economic conversation with somebody used to intercompany transactions and things like that.
Exactly.
Yeah, that's a great point. So have these conversations, Jinkan. I really appreciate you coming on. We'll be talking again soon on here, I'm sure.
Yeah, tariff is the big thing. We should talk about tariff at some point of time.
Yeah, for sure. Yeah, let's do it. Thanks a lot, Jinkan. Thanks for coming on.
Thanks a lot, Alex, for inviting me.
All right.